Welcome for our lesson for today. I think and I hope you feel good. Today we will learn about asset allocation, balancing your wealth. Let's talk about how to mix stocks, bonds, and real estate so you hard earning money, build lasting security, and grow without giving you sleepless nights. What are the core asset classes? Before we start building your perfect portfolio, we need to meet the big three PR of personal finance. Each one plays a completely different role in your wealth journey. What is the first? The stock, the equity. If you're buying a tiny piece of companies, high growth potential, but expect a wild, bumpy ride along the way. The second, the bonds, the fixed income. Lending money to government or corporation, they pay you steady interest and act as a financial cushion. And the third is the real estate. Physical brick and mortar properties offers reliable rentals, cash flow, great tax perks, and long-term value growth. Asset allocation, let's take the formula and the metrics. Your total portfolio value is the complete baseline of your investable net worth. The asset class weight is show your true percentage exposure to check if you are diversified. The rule of 110, a classic rule of thumb to automatically shift towards safety as you get older. And the net rental yield measure the true cash flow profitability of your real estate investment. Why balance your assets? Look, putting all your egg in one basket is a recipe for a financial headache. If you only one stock, a market crash can wipe out decades of saving in a week. Balancing acts like a shock absorbs on a car. It smoothens out the bumps so you stay on track to reach your goal safely. A balancing mix protects you from market's crash while making sure your money beats inflation over time. Theoretical calculation, the 60-30-10 split. Let's look at a practical math example for a balancing for a war 100,000 portfolio to see how the number actually look in a real life. This is a sample table show you your money. The grow pool is your money in stock 60,000. You have 60 percentage of your total wealth. And the safety pool is your 30% of your total wealth, 30,000. And the alternative income pool is the 10% of your total wealth. So the 10,000 of your money. And your target strategy is classic moderate growth. mix for steady long-term building. So, when your graph pool have an issue, you have your safety pool, and you have an alternative income could you use to reinvest after a war issue. Let's continue. Let's visualize the portfolio splits. Interpreting the mix. As you can see, the 60% of your money is aggressively chasing market growth, while 40% is split between stable bonds and cash producing real estate. This specific split keeps you heavily invested in the global economy but drastically limit your downside when stock market have a bad years. Rebalancing back to this target once a year force you to sell high and buy low automatically. Let's take a real life scenario, the market dip. Think about your friend David. Back in a major stock market correction, his pure stock portfolio dropped by 30% in just a few months, panicking him into selling at a loss. Meanwhile, his sister Elena had a balancing 60-30-10 portfolio because her bond held steady and her real estate paid monthly rent. Her overall portfolio only dipped by 12%. She stayed completely calm, collected her dividend check, and let her money recover beautifully. David's all stock routes dropped 30%, lead to emotional panic selling. Elena balance routes dropped 12%, felt safe, reinvested, and won big. Portfolio tweaking, your secret weapon. How rebalancing work? Here is the best part. Asset allocation isn't set in stone. If your stock do amazing and grow from 60% to 75% of your portfolio, your risk gains through the roof. Rebalance means trimming those winning stock and buying cheap bond to reset your safety net. Risk management. Keep your from accidentally taking on more risk than you can handle. Buy the dip force you to buy underperforming assets when they are on a sale. Automated success takes the guessing game and stressful emotion completely out of your investment. Let's take an expert tip to customizing your mix. Check your time horizon. If you need your money in less than 5 years, lean heavily on a bond and cash. If you have 20 years, load up on a growth stock. Use rates for easy real estate. Don't want to be a landlord. Real estate investment choose let you own commercial property without dealing with leak toilets. Automate your rebalancing. Set up a calendar reminding every 6 or 12 months to check your percentage and tweak them back to your target. Factor in your human capital. If you have a highly stable job, you can afford to take more risk with stock. If your income fluctuates, keep more bond handy. Let's stay and take a key takeaway for practice in your daily life. Diversifying everywhere. Never let a single asset class detect your anti-future. Spread the love across stock, bond, and real estate. Age detect risk. Be aggressive when you are young and have time to recover. Then slowly shift to bond to preserve your nest egg. Rebalance annually. Check your mix once a year. Trim the overground sector and water the dry ones to keep the system working perfectly. Peace of mind rules. The ultimate portfolio is the one that lets you sleep soundly at night. Match your allocation to our true comfort level. Managing your wealth doesn't have to be a gamble. Once you balance your growth, income, and tangible asset, you build a blueproof engine for a more personal freedom. That is our lesson for today. Thank you very much to stay with me till the end. And I suggest you to subscribe to our channel to help me to grow our channel. Thank you very much and see you soon.